So you're probably wondering, well, I have this picture of this fine looking fellow here named Mr. T. And Mr. T is going to become your friend going forward, okay? So my name is Mr. T and I pity the fool that don't call me. Because especially when you move on to intermediate, T accounts are definitely going to be your friend. You're going to use them for other stuff later on. That's why I'm talking about Mr. T, because Mr. T relates to these things called T accounts. As we discovered the other day when we were looking at transaction. Owner puts money in the business, company buys inventory from supplier, company sells inventory to customer. So those are all transactions. And then what we did is we set up that worksheet table and we put all our transactions into the table. Common shares goes up, cash goes up, accounts receivable goes down, cash goes up, those kinds of things. And we put them into that worksheet where we had all of our accounts, and our accounts were our asset accounts, liability, equity. And in the question we did the other day, what did we have? Probably about 10 columns or something like that. Well, that's only a handful of accounts. You got a few assets, a few liabilities. Well, imagine a company that has 20, 30, 40, 100, or 1,000 accounts. And do you think it would be really efficient to have 100 column table to put those transactions in, plus 100 here, minus? No way, forget it. It doesn't work that way. So that means that we needed to come up with a better way. And some Italian fellow centuries ago in Italy came up with the double entry accounting system, which is what we have today, and it still exists. And so what it does is it allows us to overcome the limitations of the worksheet and get transitions into our system. We look at this thing, first of all, called the normal balance concept. You'll notice that I was introducing this to you the other day already when I looked at assets, liabilities, and equity. Didn't I kind of draw it with a big T? The balance sheet can be represented by a T. And under each of these categories of assets, liabilities, and equity, we have our accounts again, right? We have cash, we have accounts receivable. Well, it turns out that each one of those has its own T. So a T account is simply a representation of dollars going in and out of an account. So we have cash, we have accounts receivable, we can have a building. And what happens is with our big T, we have a left side and a right side. So the left side is what we call the debit side. And the right side is what I'm going to draw a dotted line here, is what we call the credit side. Think of it as two sides of a street. So one side of the street is the debit side and the other side is the credit side. Just like houses on one side of the street are all even numbered and one side of the street are all odd numbered. So what happens is all the accounts that live on the left side or the debit side of the street have what's called a normal balance that's always going to be on the debit side. So a normal balance means it's normally a debit account. It's normally a left side account. That's the best way to describe it. And so what that means is that cash, for example, and the way to remember this is to pick only one asset. All you need is one. And then it doesn't matter. All other assets will behave the same way. So cash will go up on the left side with debits. And that means it goes down on the right side with credits. And that's how we are able to visually see money going in and out of accounts. So if you look at a T account for cash, and you see numbers going in on the left side, you know that that's cash going into the bank account. And then when you see stuff coming on the right side, that means it's cash going out. Now, I do not want you to think of this as pluses and minuses, because if you do that, you are now going to get confused. The other thing I don't want you to do is don't go in your online banking and look at your bank account, because your bank account also uses debits and credits into your account, but they're actually the opposite, because a bank account, your bank account, is actually a liability to the bank. So your bank account actually would be on the liability side of the bank's balance sheet, because it's your money, not the bank's money, and they owe it to you. So it's a liability to them. And the transactions in and out of your account are actually from their perspective. So don't look at your bank account. So accounts receivable also goes up on the left and down on the right, etc. Then we have a bunch of accounts on the left side. We had, remember, accounts payable. We had maybe a loan payable. We have salaries and wages, all kinds. Well, these are on the right side of the balance sheet. So because they live on the right side of the balance sheet, they will always have a normal balance that's on the right side. So again, if you think about a street where all the houses on the left side of the street will have even numbers, all the houses on the right side of the street will have odd numbers. So if a new house is built on the left side of the street, it's going to have an even number. Okay, that I'm just trying to come up with different ways because I know debits and credits is something that really just, it's tough for some people to wrap their heads around. It takes them a while. So this means then that liabilities will increase on the right side. So when you look at a liability account and you see numbers going in on the right, that means that the liabilities are going up and that they go down on the left. And then we have equity. Remember the other day we had common shares? And then we had something called retained earnings. Well, these are both on the right side of the balance sheet, so their normal balances are going to be on the right side. By the way, it's possible at some point for an account to actually become negative. So its balance may temporarily end up being on the other side. Okay, so it's not to mean that it can never happen, but normally, that's what we say, the normal balance. Normally the balance is such. And if our cash goes into a situation where its balance ends up being on the right side, that actually means you're overdrawn because you would actually have a negative bank balance in your account if your cash balance is on the right side. Well, that means you actually owe the bank money. So that would be classified as a liability. So that bank balance would actually end up on the liability side. And then it makes sense because it has a balance on the right side, so it belongs on the right side. Now, retained earnings is kind of a special little case here. Remember the other day, didn't we say that retained earnings is the result of net income? Where we said that retained earnings is the net income that is retained in the business, which means not paid out to any of the shareholders. Well, isn't net income equal to revenues minus expenses? If retained earnings, its normal balance is on the right side because it's on the right side of the balance sheet, can we make a guess here that if I were to draw a T account for revenues, what the revenues normal balance might be? Do revenues cause retained earnings to go up or down? If you are increasing, if you're selling more, Avneet says it's a credit side. And it is, because as you generate more revenues, revenues cause profits to go up. If revenues go up and profits or net income goes up, and that net income is not distributed to the owners, won't the retained earnings go up? So here's something cool to remember. R for retained earnings, R for revenues also match up with the R in the first letter of the word right, right being the right-hand side. So retained earnings and revenues are R accounts. R is on the right side, so that means that they're credit because they're on the right side. So the normal balance for revenues is the credit side. So we could say that underneath retained earnings would be revenue and its balance is over here. Well, can you now guess what expenses might look like? What side would expenses have their normal balance on?
Left side.
Left side. Because if revenues cause your profits to go up, expenses cause your profits to go down. As you spend more money, net income goes down, and then that net income ends up in retained earnings because it's not paid out to shareholders. What happens to the retained earnings? It goes down. So expenses like that. So this now describes the big T and all the little t's underneath. And then we're going to start going through transactions and saying, okay, this goes up, this goes down, goes up on the right, goes up on the left, debit, credit, that kind of thing, okay? And all of this is necessary to keep our accounting equation in balance. So the double entry system actually requires at least two accounts, one that's going to have a debit and one that has a credit. That doesn't always mean that one goes up, the other goes up. If they're on two different sides of the balance sheet, they will. It's possible that one goes up, one goes down, or one goes up and three go down. There's all kinds of combinations. It's limitless. The point, however, is that assets are on the left, they're debit accounts, liabilities, shareholders' equity are credits, and they're on the right side. And then, of course, because revenues and expenses fall under shareholders' equity, whether they go up or down, revenues are also right side accounts, expenses left side accounts. And we use that normal balance side to increase that account. And which means if we want to decrease an account, we use the opposite of the normal balance. I'm just going to briefly now talk about how this comes into context in this thing called the accounting cycle. We are now familiar with the chart of accounts. And a chart of accounts is just the list of accounts. And actually, if I go into this next slide here, chart of accounts is just this, a list of accounts. We have assets, liabilities, equity, revenues, expenses, and dividends. That's all a chart of account is, just a list of accounts. So our accounts will have balances in them. Whether the balance is zero or whether the balance is something else depends on the type of account there is. So we're going to talk a bit about two kinds of accounts. There's permanent accounts and temporary accounts. Okay, so temporary accounts are temporary, and those will include revenues and expenses. And that means they're temporary because at the end of every year, we hit the reset switch. We flush it out to zero. Whereas balance sheet accounts like cash and accounts receivable and all liabilities, they're perpetual accounts. They continue to roll forward. So we don't reset them to zero. And the reason why we do that, and that also explains why the balance sheets the titles are worded the way they are. So if an income statement is for the year, that means we start the year at zero and end the year at whatever the number is. So we take sales, for example. When we start a new year, we don't have any sales to begin with, and we start building up. Same thing with all the expenses. When we get to the end of the year, we calculate our income, and then we start a new year, we hit the reset button. Well, with cash, if you just think about that one account, is there cash in your bank at the beginning of the year? Sure there is. And there's cash in the bank at the end of the year. Well, that becomes the beginning balance for the next year. So that's the difference between permanent and temporary accounts. But every account has an opening balance, even if it's zero. So what we did the other day is we analyzed transactions. That's the chapter 2 stuff, where we had the worksheet and we had cash up, this thing down, all that. By doing that, we actually were doing the next step. We were recording transactions, but you didn't know it. So what we're going to do now is use a more efficient way of doing that in what we call a general journal by making what we call journal entries. A journal is like a diary of transactions. So some people keep a personal diary, or some people call it a journal. Well, that's what an accounting journal is, where we write debit this, credit that. And then at the end of a period, it could be a day, a month, a week, they're posted to what we call the general ledger. So the general ledger is basically the list of all the accounts. If anybody has ever seen A Christmas Carol with, the old black and white movie with Scrooge, and the guy that works for him, Bob Cratchit, he's working away at his desk and he's got a very big book open. Well, that's called a ledger. And he would be writing in the big book. These terms actually are centuries old that we're still using today, but we don't use these books anymore because everything's in the computer. And we still call the computer books and bookkeeping, even though there's no physical book. So we post those to the ledger. Then we create basically a list called a trial balance that just says, here's all of the debit accounts and the credit accounts. And then we make sure they're equal. And as long as they're equal, it means that everything's okay. It doesn't mean that things are always right, but at least it means that things are balancing, and that's good. And then we'll make some things called adjustments, and then we'll create what we call an adjusted trial balance. And those are the numbers that we would use to create the financial statement. Well, if you remember what we did the other day with the columns, the very last number, wasn't that the final numbers where we added up all the numbers in the columns? Well, those final numbers are the ones we use to create the financial statements. We're going to do the same thing, but instead of having all the numbers in columns, the trial balance just puts everything vertically and lists the balances that way without all the other detail. And then we will close entries and start the period over again. I talked about opening balances, and I said, so assets, liabilities, and equity are permanent. Revenues and expenses and dividends are temporary. And again, that means that these are reset, right, at the end of the period. Now we get into looking at how we record these transactions. Transactions are initially recorded in a general ledger, and then they are posted. That's what this word should say here, to the GL. So a journal entry looks like this. It has a date and normally has a number attached to it. So, number 5007. That's just a reference so that we know what journal entry number it was. So we can, if we're doing an audit, we can trace transactions back. Basically, we list debit accounts first. So whenever we're going to debit something, it goes first. So in this one, we can see that we have a debit to cash for $1,000. And then any credit accounts are indented. They're shifted over. So here, accounts receivable gets a credit of $1,000. And we would normally include a description or a narration in part of the journal entry to explain what it is that we did. So if we're being audited, or let's say somebody dies, all right, the bookkeeper or somebody dies, somebody else comes in. Well, how do you trace through and understand transactions if there's no description? Sometimes they're easy. I could look at this entry without the description, and you could too when you know what you're doing, and look at that and go, cash goes up, accounts receivable goes down. They must have collected money from a customer. That's the only thing to explain that kind of transaction. So many transactions are actually very apparent. It's very obvious what they are, but many aren't. The other thing as well, of course, is that the debits must equal the credits with each entry. I can't complete an entry unless the right side equals the left side. And we usually do debits before credits, not because if you do it the other way, it's wrong. You could do it the other way, where you have a credit first and then a debit. But how many of you have ever experienced somebody taking their nails and drawing them down a chalkboard, or chewing on cotton or something like that? That's what an entry that's done the other way does to an accountant. It makes us cringe. It's like, oh, or it's like a bad taste in your mouth. It's not that it's wrong and going to kill you. It just doesn't look right. And accountants are kind of picky. The other thing then is, now this is really cool. Look at this. What did I do there? That shows you where the individual T accounts, which side the numbers will be posted to. This means that later on, I need to post. So post means take those numbers and put them into their respective T accounts. So I'm going to have a cash account and I'm going to have an accounts receivable account. And looking at this entry, this says cash will get a debit of $1,000. Accounts receivable will get a credit of $1,000. You see the beauty of the T? My name is Mr. T, and I pity the fool that don't call me. Always use a T account.